everyone. I hope you are doing well, and we are back with another video. We will be continuing our discussion on the capital asset pricing model, and today will mostly be on Excel so that we can see the CAPM in action and also talk a little more about the beta calculations. As a refresher, the CAPM return is equals to the risk-free rate, which is the rate that we get on government-issued bonds or securities, plus the beta times the market premium, which is the return of the market, minus the risk-free rate, which is essentially the premium that we'll be getting for investing in the stock market. Now, let's take the example of an ice cream shop to understand the relationship between dependent and independent variables, and then use that to build upon our understanding of what we mean by beta. Okay, so on the x-axis in this graph, we have the temperature. This is our independent variable. And on the y-axis, we have the sales. Now, as you can see from the red row, that when it was 24 degrees, we had a sales of 100 ice creams. When the temperature rose to 25 degrees, our sales increased to 150 ice creams. This continued till the temperature increased to 27 degrees and the ice cream sales increased to 250 degrees. We can quite clearly see that as the temperature increases, so do our ice cream sales. So the relationship between the dependent and independent variable is a positive one. The scatter plot that we have here is quite neat, and this relationship is quite clear. However, actual stock returns are quite messy like this. Now, if we wanted to see that with 1 degree increase in temperature, how much do our sales increase by? We would take the slope of this trend line or this line of best fit. The best fit line shows the overall trend in a data set, meaning that if with the temperature increasing, our sales are increasing, the best fit line will show an upward sloping trend. We will see in a later example that this trend line can also be downward sloping when the trend is negative. One thing to note is that our points are laid out perfectly, so the trend line passes through each point in the dataset. When we'll move to our real life examples, we'll see that this is not always the case. To reiterate, the trend line is a depiction of the average movement of the data points, which means that if the x variable is moving in a certain direction, on average, what direction is the y variable moving in with relation to x? Now let's suppose there is another shop which sells soup. As the temperature increases from 24 to 25, the soup sales fall. From 25 to 26 degrees, they further fall to 100. Finally, when the temperature reaches 27 degrees, their sales fall to about 50. Now, this is a negative trend which can be seen from the trend line. The question then becomes, how would we assess the change in sales due to a per unit increase, which basically means that if the temperature changes by 1 degree, how would our sales be affected? Well, we simply take the slope of the trend line. If you're doing it on Excel, you first take your known y variable, which is the variable being affected by the dependent variable. In our case, this is the sales. And then you take your x variable, which is the factor which is having the effect. In our case, this is temperature, and you take the slope. We get a slope of negative 50. This means that as the temperature is increasing by 1 degree, your sales are falling by 50 units of soup. Similarly, in the case of ice cream, if the temperature is increasing by 1 degree, you see that the sales are increasing by 50 units. Now, suppose that we plot on the x axis the market returns and on the y axis the return of a stock. Well, this scatter plot tells us the effect that the overall market has on the return of a stock. The slope of the trend line of this particular plot is the beta, which basically shows us that if the market, for example, in this case, increases by 1%, the stock is increasing by 1.2%. Another way of thinking about this is to consider the beta of the market, which is 1. Don't believe me? Check for yourself. If you draw a scatter plot with the market returns on the x axis and the y axis, and we take the slope of that trend line, we get 1. And this will hold true always. So the beta of the market is 1 and the beta of our stock is 1.2. This means that the stock is 20% riskier than the market. Moving on, and this is a rare occurrence, but it is also possible for a stock to be negatively correlated with the market, and therefore it will have a negative beta. For example, if the market increases by 1%, the stock decreases by 1%. A negative beta represents the stock returns moving in the opposite direction as the general market trend, and a positive beta reflects movement in the same direction of a stock's returns as the general market. We now look at the real life example of Fauci fertilizer. I took data for a year from November 3rd, 2023 to November 3rd, 2024. Weekly data was used. We are taking KC100 as the proxy for the market. The first thing you'll notice here is that the plot here is very scattered, pun intended, and it's not as neat as our examples. And that's because real life is messy. I want you to focus on the red dots, which are larger than the rest of them. We start from the right. It is possible that there may be a day where the stock market went up and Fauci fertilizer went up. There may also be a day where the market went down. If you can see, we're on the negative side of the x axis, and Fauci fertilizer went up. There may also be a day where both the market and Fauci fertilizer went down. And lastly, it's also possible that the market went up, where on the right side or the positive side of the x axis, and Fauci fertilizer went down. These points, however, do not represent the overall trend. As we can see from the trend line, that it is upward sloping, which indicates a positive trend. And if we take the slope of this line, we get the beta. Fuzzy fertilizer for this period has a beta of 0.97. This is not negative, yet Fuzzy is slightly less riskier than the market. So if the market goes up by 1%, Fuzzy will go up by 0.97%. And if the market goes down by 1%, Fuzzy will go down by 0.97%. If we consider the stock of PSO, we get a beta of 2.08. This means that it is twice as risky as the market. So if the market goes up by 1%, PSO will go up by 2%. Finally, to tie it all up, we use the CAPM to find the required return of FFC, or the expected return. I'm taking an assumption that the risk-free rate, or the rate expected on government securities, is 15%. I add to that the market premium, which is 69% from the period of November 3rd to November 4th, 2003 to 2024, and I multiply it by the betas of both FFC and PSO in their respective cases. For FFC, we get an expected return of 62.5%, and for PSO, we get a return of 117%. These numbers might seem a bit inflated, but that's partly due to the bullish market trend that we're currently experiencing. Hope you found this video helpful and now have a better understanding of the capital asset pricing model and beta. Let us know in the comments below other topics that you would be interested in, and stay tuned for more videos. Thank you.